right, welcome back, everyone. So, first is just a quick administrative announcement regarding video timing and stuff. So, I felt like having videos every week was getting to be a little much. I felt like they were getting a little bit boring, and rather than doing every week, I'm going to do every other week. Just more will happen in the market. There'll be more news to talk about, and I'll uh, brainstorm more investing tips and strategies to share with you guys. So the videos will be bi-weekly and they will be longer, right? So this video is going to be a bit longer than usual. And that's just because I have 2 weeks of information to talk about rather than just one. So don't be alarmed. I'm still here. I'm still going to give you guys these portfolio updates. It'll just be every 2 weeks from here on out. Second thing I want to talk about is um, my take on people trying to time the market, trying to buy low, sell high, like with a lump sum, rather than kind of easing into the market with dollar cost averaging and being a little bit more cautious of risk, And then my take on time in the market, so a buy and hold strategy. So there's kind of there's strategies to enter the market and there's also strategies to exit the market. And I'll be talking about both of them and what I prefer. Okay, so moving on to Robinhood, my portfolio update. I've sold out of a couple positions and I bought a couple shares of just these ETFs. As you guys know, I'm uh, going away from buying regular stocks in Robinhood and just going to go towards just an ETF only portfolio along with heavy cash, because this is actually, I'm moving this to be my primary bank account. So I'm going to be using Robinhood as my checking account essentially that earns a 1.8% interest rate, with half of that money invested in ETFs that track the domestic market. So my 2020 goal for Robinhood, I'm sure you guys are interested, is to have about $16,000 in Robinhood and having at least half of that invested, most likely more. So looking at about 10,000 invested. So that's 10,000 in these ETFs right here, and about 6,000 free as just cash earning interest. So I'll go ahead and show you guys my cash, and I have about like 2,400. Yeah, so I've got some on the way. Robinhood takes about 5 days to transfer. I don't know why. And I've earned $1.63 this month, so that's awesome. And that's guys, this $1.63 is I've earned it, and it's absolutely risk free. It's just matching inflation. So I'll just put all my cash here and I'll never lose money from inflation, like you would if you had a lower interest savings account. So that's my Robinhood strategy from here on out. You guys already know this, and I'll keep you guys updated. So right now we're sitting pretty nice at, $7,100, so I'll take it. All right, going on to M1 Finance. So M1 Finance, I've changed a little bit, and the only sector that I've really changed is consumer. So I was just browsing the web, and I sold Unilever, and I think that's it. I sold UL, so Unilever. I just was looking at their financials and I wasn't very impressed. And I really just kind of wanted to consolidate this sector a little bit. I don't want all these. I am going to sell more, namely these car manufacturers here. Most likely, when I can get rid of it, I'll be selling Fiat Chrysler. General Motors, I'm okay with. I think GM is transitioning well into the electric vehicle market. I think they have such huge assets and such a nice balance sheet that they'll make it through this transition. Fiat Chrysler, on the other hand, I'm not so sure. So I will be selling out of Fiat Chrysler when I am more comfortable eating an 8% loss. However, Costco, I did go ahead and buy. This is again my long-term strategy here. This portfolio I plan on having until I die. And I think Costco will be here until I die. And I think they have expanded. They're normally a northern company, and now I'm starting to see them in Texas and everywhere. And I just think that their whole philosophy behind their business, their cost differentiation strategy, just everything about them is excellent. They also invest in their employees, so you can't really go wrong. And I'll be buying Costco from here on out. And then the last one that I picked up is Disney. Yeah, there's a lot of news, and no, it's not because Disney Plus actually. It's actually because I didn't realize this, but Disney owns quite a few uh, telecom companies, not telecom, but like streaming services and entertainment uh, businesses. So Disney actually owns ABC. They own ESPN. They own quite a few uh, big, channel networks that have a lot of content trademarked. So huge revenues. I didn't know Disney owned that, and now that I do, I went ahead and picked up Disney. I think Disney Plus is going to do great too. Star Wars is going to do good. Disney also owns Marvel, so they own uh, as much as you can get. They also have a huge stake in 21st Century Fox. So Disney is basically the entertainment mecca, and streaming services are only going to get more used as more people get access to the internet. So that's my take on Disney. I think you can't go wrong buying Disney either. Even if it goes down in the short term, I think it's going to go. I think it's going to go really, really well in the long term. And I know they aren't the highest dividend payers. I know it's below 1%, but you have to have some kind of growth stocks too, and they are paying a dividend, so they do care a little bit, right? So that's all I've changed on my M1 Finance. I've got 4,300 in here, and my goal for M1 Finance is to have 10 grand flat by the end of 2020. I think I'll do that no problem. So this is where my M1 is at. Okay, so now I'd like to talk about timing the market versus time in the market. So Vanguard here has like this little article on how to invest a lump sum. So you can either there's two approaches, right? It's just to invest it all at once, and then you can watch your lump sum go up and down drastically throughout each day. Or you can dollar cost average and just kind of set a strategic amount of money every week, every day, even until you're kind of entered the market. It's kind of easing into the market, which uh, gives you less exposure to risk versus if you were to put it all in on one day. And if the stock market just crashes the next day, you're screwed. Rather than you just put in, you know, a very small fraction the very first day, and then the stock market crashes, and you put a bunch in the next day too, and you're not as exposed to as much risk, right? So that's basically the difference between just putting all in and doing dollar cost average. My personal philosophy, as you can tell with M1 and Robinhood, is to just ease into the market as slowly as possible. So I'm putting around $150 into Robinhood a week and around $200 into M1 a week, and that's it. That's all I'm doing. I'm not gonna put in $5,000 in M1 because that's gonna just that one day. I don't trust that it will go up or down after that, right? So I would rather just dollar cost average and just kind of have my average line going through the stock market line, right? So buying and holding versus timing the market. So that's your entrance, right? Is to dollar cost average. So you want to ease in. You don't want to put it all in at once and then, be sitting there stressed out, watching your portfolio go up and down the next day, right? You want to dollar cost average, put 100 in each day or whatever. So that's how to enter. That's my philosophy on how to enter. You want a dollar cost average. So how do you want to exit? Um, the best answer to that is you don't. so you just want to live off the dividends and never have to sell. That's what I'm doing, right? So again, if you don't know already, I'm treating this as like a house, okay? The best example for my portfolio is a $4,000 house. So my $4,000 house is paying me rent. It's paying me a proportional amount of rent for a $4,000 house is worth, right? So if you were a tenant living at a $4,000 house, you can imagine it's probably not that nice. So you're probably paying me not that much to live there. So if you go to my earned dividends, $40 for all, but for the week, I have $2. For the month, I've earned $18. Okay, so I'm charging about $18 a month for rent, okay, for my $4,000 house. But let's say I have a $200,000 house. If you have a proportional amount of money, so if I have a $200,000 house, then I'm going to be charging around $300 or $400 for rent a month, right? Because that's how much the house is worth to rent at, okay? But it's the same principle here at dividends. So it's proportional to how much money you have in the market, of course. And as I invest in my house, I earn more rent. I earn more of a paycheck. So that's how I'm viewing this portfolio. I'm not viewing it as I'm in here for market gains only and I only want it to go up in value. I really don't care if it goes down in value. If it goes up or down or whatever in value, I don't care. All I care about is how much rent I'm getting, because I plan on holding this house forever. So that is my take on my portfolio. I hope you guys, kind of learn to treat your portfolio like this rather than trying to jump in the market and ride it up and then sell out of it. And no, it's better to just kind of build your little house. The link will be in the description for all the stocks that I have here, um, and just kind of pick and choose the foundation of your house and then start charging rent. And that's how that works. So again, back off that tangent. Buying and holding is what I subscribe to. Timing the market. There's been studies done where if you try to time the market, even if you invested in the lowest of the low point, which is impossible to determine, when the stock market is crashing, everyone's world is ending, right? So when you're at the very bottom of the market, no one knows when the bottom is. You can keep putting money in and it can keep going lower, and you just keep losing money essentially. So even if you were to invest at the very bottom of the market, someone who was dollar cost averaging the entire way through, even during the recession, just keep putting money in, not looking at the news. Even if you time the market perfectly, you would still not have made as much as the person who dollar cost averaged before you tried to time the market, right? And that's over a span of about 30 years. So if you're looking down in the future and you have 30 years from now, then go ahead and start investing now. Even though people are saying the market's expensive, doesn't matter. You'll be missing out on gains that you'll want to have. Okay, the most valuable thing that we have is time, and especially time in the market. So the longer you can be in the stock market, the better. With the most amount of money you can. Being as risk adverse as possible by dollar cost averaging, the entrance, right? All you want to be doing is entering the market. You kind of never want to be exiting the market. And then, of course, we go to how to tell if a stock is expensive or not, because if it's going to drop for the next 4 months, then you might want to wait and just buy a different stock. You're still in the market. So how to tell if the stock is expensive or not? It's really simple way of doing. Very simple, honestly, to see if a stock is expensive or not. So Coca-Cola I have up here as an example because it's an expensive stock right now. And there's two main things you can look at. So you can look at the dividend yield graph. I've been over this before. So on average, the 4-year average yield of Coke is 3.3%. So anything above 3.3% means that Coke is going to be relatively cheap compared to its 4-year average. It's because Dividend yield is simply just your annual payout divided by the last closing price. So it's just 1.6 divided by 56 is 2.8. So if you have a lower closing price, then the dividend yield will go up. And if you have a higher closing price, the dividend yield will go down. And as you can see, over the past year, 8 months, Coca-Cola's dividend yield has been plummeting. So it remains pretty steady, pretty steady. There's a couple drops here. There's a couple spikes. That's a good time to buy it right here. A couple spikes. There's even a spike right here, but it's not anywhere near 3.3, right? But this one is over at 3.5. That's amazing. That means that the stock is cheap, and you can see it went down to about its average, and then it kept going and going. And now we're at below a 3% yield. So in my opinion, Coke is relatively expensive. Now you can't take this alone, this data alone. You also have to look at the dividend growth, and you have to make sure the dividend growth is going up, just like it is here, right? It's going up every year. This is perfect. So the dividend growth is going up, and the dividend yield is going down. The stock is expensive. That's the simplest way to tell. If right now I wouldn't recommend investing in Coke, and so that's how you kind of buy the dip or tell if a stock is expensive or not. Okay, so that's honestly all you really need out of seeking alpha. The other way that I research stock is through M1, and we can just go here to Coke, and I just look at the P/E ratio. So on average, the S&P 500 has a P/E ratio of about 15 to 20, and that is your price to earnings. So that's the price of the stock compared to the earnings of the company. So basically, and as a stockholder, you share in the earnings of the company. So as the P/E ratio gets higher, you're losing kind of value essentially in the stock. When the PE goes above about 28, in my opinion, I don't ever buy a stock. And as you can see, Coca-Cola's is 31. So again, just another way of telling if a stock is expensive or not. I know it's kind of hard to tell. So right now, I don't invest in Coke and just find other stocks that aren't as expensive. Although the market is getting a little high, it doesn't really matter, because if we go back here and we just go to, SPHD, which is a high dividend, one of my favorite ETFs ever, and we just go to their dividends and their dividend yield, it's above their 4-year average, okay? So the market itself is not high. There's a few key stocks like Tesla, Disney, and Coke that are all a little bit expensive right now. And that's nothing to be too concerned about, okay? So that's how you kind of navigate if a stock is expensive or not. So I hope you guys enjoyed this episode. I'll be doing another portfolio update in 2 weeks. Hopefully we make it to 5,000. I think we will in 2 weeks on my M1. And I'm aggressively putting money into Robinhood as much as I can, and really trying to earn that free money, that risk-free $1.63. So that's pretty much all I had for you guys. So hope you guys have a good day, and I'll see you next time.